Okay, welcome to the webinar. Tonight's topic is the power of dividends, and we're specifically going to look at some of the tools on the GuruFocus.com website that can empower you as an individual or institutional investor to add quality dividend holdings to your portfolio. We're going to show you the benefit of doing that as well. So let's go ahead and get started. There are four main areas I want to address tonight that are going to help you find good candidates for a dividend portfolio. The first is the Dividend Stocks tab. It's located under the Screeners and Tools heading. We'll kind of show you what that is, what stocks that pulls together, and how to use that in your research to put quality equities into your account. The all-in-one screener, which is, in my opinion, the most impressive stock screener anywhere in the world, and it has parameters you can use specifically for dividend investing to drive down a list of quality candidates that meet your criterion, and we're going to walk through what you should be looking for and how to filter down that to a workable list. And the third is the Guru Current Portfolio. So you know that on the Guru Focus website, you can go to Warren Buffett, you can go to David Tepper, you can go to any number of professional money managers and see what they are currently holding. Now, there's a tab within that called the Top Yield tab that's going to show you what the top yielding stocks in their portfolio are. And then finally, we're going to look at the articles section, okay? The articles, again, this is not a top tier place for research. It's not going to give you hard data, but sometimes if you're just looking for new candidates, you're looking for new ideas or new baskets of stocks, you can search the articles section for top reads on dividends. We've got a lot of professional money managers who are contributing content to the Guru Focus website, and you might find some pieces there that shed light on areas of the market you have not previously looked at. So we're going to go ahead and start with the first one. We're going to go to Screeners and Tools at the top and then pull up the list of dividend stocks, and I'll show you what those are. But before we get started with that, what I'd like to do is give a quick 5-minute spiel on the power of dividends so that this information kind of takes hold for you. So I put together a little spreadsheet. Let me bring this over for you just to kind of give you a hypothetical example, okay? Now let me zoom in on this just a little bit. Let's see if we can't make this screen a little bigger for you. Well, it's about as big. Oh, excuse me. There it goes. Okay, well, we'll just leave it as is. So what we're looking at, the first table here is just assuming some very basic investments, okay? What we've got is I'm trying to find my little drawer so I can make this easier for you guys. Well, we'll just use the tools here. So a couple of things. Here are the basic assumptions down the left side. Okay, we've got an initial investment of $100,000, and just for hypothetical purposes, we're going to assume a dividend portfolio that yields about 3.5%, which is what you're going to find in some of the top quality dividend paying stocks in today's market. We're going to assume a dividend growth rate of 5%, okay? And one of the tricks to top quality dividend stocks is finding those companies that have a long, successive history of increasing their dividend. And while the yield may stay the same, as the stock price increases, their dividend should grow in dollar terms to increase that yield on cost for you. Now, in the first example here, there is no dividend reinvestment. So this is someone who's just putting $100,000 in, they're taking their dividend checks, they're spending on whatever they choose, and the stock is not growing whatsoever. So kind of think like AT&T the last couple years. And this is what the graph looks like going out over 25 years. So initially, a $100,000 holding is yielding you about 3.5%. You're taking that income with you, the $3,500, so you remain at about $100,000. Now, the center column is your yield on cost, and what that represents is what the current dividend payout is yielding you based on your initial investment. So, as the dividend payment continues to grow, your yield on cost increases, right? If you bought shares at a later date, you wouldn't have the same yield, but your yield on the initial value increases. So what you do over about a 25-year period, you collect a nice little stream of payments here, which increases each and every year, assuming they maintain their history of increasing the dividend payout, and your yield on cost increases as well. Now, of total over a 25-year period, you're collecting roughly, if you can't see it in the bottom right of the screen, about $167,000 in dividend income, and your portfolio remains the same. Okay, this is just a bare bones kind of a baseline to judge the others on. So the next example here includes reinvestment of those dividends. So what this is using for assumptions, the same $100,000, the same 3.5% dividend yield, the same 5% annual dividend growth rate, but they're reinvested. So this income column here on the left, your dividend checks, instead of taking those and spending them, it's letting it reinvest, and it's taking those dividends and buying additional shares each year. So what that does is affect your right-hand column here and increases the value of your holdings, and you get that compounding growth that we know is extremely powerful to investments. So the yield on cost grows at a much faster rate because the dollar amount of those holdings continues to increase as this dividend income is reinvested into shares. So our previous example grew to about 11.5% yield on cost. This one grows to a 50% yield on cost. That initial $100,000 investment at the end of 25 years not only is worth $500,000 or 5 times, 500% increase, but you've got a $50,000 annual dividend income stream and growing. So we can see the difference here. In the previous example, there's charts over on the right side. Notice the red chart, which is the portfolio value, stays the same at 100 because you're taking all the dividends. And your annual paycheck slowly grows and grows and grows up to around $11,000 mark at year 25. The second example, since you're not taking those dividends, you're reinvesting them, you are seeing your portfolio grow exponentially up to the 500,000 plus mark. And as soon as you decide to turn on those dividends, in other words, stop reinvesting them and take them as a paycheck, you've got a $50,000 plus and growing per year income stream on top of your $500,000 asset pool. Now, I got a question asking if the second scenario is assuming the price of the stock stay the same. Yes, that is correct. I mean, this is assuming the stock price does not change 1 penny in 25 years. So you bought shares of a stock at $50, 25 years later, it's still $50. There's no stock growth. All you get is a dividend that is increasing. Okay, so I know what you're asking, Elias, and the next chart's going to answer that question for you. The ideal scenario and how we really make money is we get this happening for us. We get dividends growing, compounding, reinvesting into that equity. And we also see stock price appreciation. How many quality dividend stocks that have a 10-year history of increasing their dividends have you seen sit still for 2.5 decades? Not many. So we're going to add one more catalyst, this final example, to put it all together. Same $100,000 investment, same 3.5% dividend yield, same 5% annual dividend increase. We're still reinvesting the dividends, but we're going to assume that the stock grows at roughly 5% a year. So a $100 stock is now $105. The next year it's worth, $111, something around there. And the total portfolio value is triple what it was without the growth. Okay, so you've got just immensely larger figures here. By continuing to invest this money and allowing the new stock to continue to grow, you're kind of double compounding, right? You're compounding the growth on the shares that would happen in non-dividend stock. You're further compounding your growth by taking the dividend payouts and reinvesting that to purchase more shares that pay more dividends and experience more growth. So all the same parameters, but with some, and I'm averaging 5% a year, right? Under the market, if we look at 25 years, probably averages 8 or 9%. I think most of you would agree these are fairly conservative estimates, right? 5% growth, 3.5% dividend yield is very doable today. Lots of companies increase an average of 5% or more. The only thing not included, as Jim pointed out, is taxes. And the reason is capital gains taxes are only applied once the sale is done. So this is assuming you just let this stay, reinvest, churn. There's no taxes until you withdraw this money. So here's what we've created from $100,000 with no reinvestment. Now you could run the same example saying, let's say I add $5,000 a year, I add $10,000 a year, and these numbers would be astronomically larger. But what you've got to do this 25-year period is $1.5 million nest egg. You've got a yield on cost of 152% because that initial $100,000 is now netting you, should you decide to turn on the spigot, if you want to think about it that way, in other words, stop reinvesting the dividends and start collecting those checks, about $150,000 a year in an income stream. Now, your holdings value will not grow as quickly once you do that, right? Because you're no longer reinvesting the dividends, but hopefully the stock continues to appreciate. And look, the odds that we find a company this quality, like a Walgreens caliber company, that stays that way for 25 years. You may switch stocks a few times within these. There may be a capital gains issue within it. You know, if you sell one holding that's grown several 100% and purchase another, and that's all part of the investment cycle. But I just wanted to show the power of dividends, reinvesting those dividends, and then combining them with some very, I think, minimal stock growth. Now, will there be years your stock loses 10, 15%? Sure. There's also going to be years where your stock gains 15 or 20%. But a 5% average growth rate of the stock, I think, is fairly conservative, and the numbers are really extreme. And if you've got more than 25 years to invest, these figures get astronomically large. But we see the difference here going from, roughly 160 taken in to a $500,000 portfolio to $1.5 million portfolio. So what we're working with, or what this kind of conclusion this makes, is that we need to find quality companies that can somewhat safely be estimated to earn 4, 5, 6% a year, that have a decent dividend yield now, and that have a history of growing dividends. What you're going to find, a lot of people just want to hunt for big dividends, right? They find a stock that pays 10%, 12%. 8 times out of 10, that's generally a red flag. You don't want to focus as much on what the yield is today, but instead the history of increasing that dividend. Because you could find a 7% yield today, but they may never increase it. And what we're seeing in these graphs is that 3.5% quickly becomes 6 and 10 and 15 and 20 in massive numbers here in just a few short years. And Jim pointed out the income stream is taxed. That's correct, Jim. It is once you turn it on. Once you stop reinvesting these dividends, it is taxed. As long as it's withheld and reinvested into the same equity, it is not. So let's go ahead and take a look. Again, what we were talking about is the 3 places that we can find these quality dividend ideas. And I want to go through some of these and show you where to find them. So the first one up top here is the dividend stocks, and you see it just near the bottom under screeners and tools below the value screen. Second up from the bottom is dividend stocks. And here's what this list is comprised of. It's producing high yield dividend stocks among your personalized list of gurus, their top yielding stocks that are yielding at least 4%. Have guru ownership. So this list could be different if you were following a different set of gurus than I am. So like anything else, it's very clickable. If you see up here at the top where it says the stocks are selected from your personalized list of gurus. So what you're going to want to do is check that list periodically and be sure you're following either enough gurus or the ones you want to follow, or you can select all of them, for instance, to get a bigger list. But these are the 17 guys on the right I'm following, and that's where my list is comprised of. So this list is going to kind of automate this for you, right? It's going to find quality stocks that have high yields that are being held by gurus, and it's going to show you a few things. By default, it's showing you the price, 52-week price range, number of guru owners, buys, PE, etc. You can customize this view by clicking Customize View here and selecting the categories you want to be displayed. So that we're not really concerned with debt to equity, the current market cap. Just for our purposes of this, let's take some of these off. And you can then select the 10-year dividend payout range, the yield, the payout over here on the left side under fundamental, about a third of the way down, and take off some of these others. And you can select whatever it is you choose, but this will just kind of clean it up a little bit. And now we're looking at, and we can even filter these by yield. So now we're looking at the stocks our gurus own that have above a 4% yield. We can filter this by payout ratio to be sure they're not extending themselves to a level that cannot be continued. We see the 10-year dividend payout range. So generally, what I like to see over here is it be obviously as far as possible to the left side of this range. And the dividend payout, what that is just it is the percentage of their income they're using to pay those dividends. Okay, let me ask, I see a couple of questions here. Let me address those really quick. And Santiago asked if you can use a dividend screener for stocks in other countries like Latin America. Absolutely. Everything we're doing here on domestic stocks, you can use for any region, any international stocks, as long as you have the data package with Guru Focus that includes those. So yes, absolutely. And this is being recorded. So that's the Guru list, and you've got a couple of ways to do it. You can do a map view to kind of get a quick idea of what sector and the movement of those stocks. You can do a charts view, which will take a minute to load, but it'll kind of show you a recent chart of each of these stocks. It'll show you both the price and also the Peter Lynch earnings line. There's several ways to view this material, and it's extremely flexible. One thing I love about the Guru Focus website, if you want to look at it based on median PE, based on here's some dividend yield charts, you can select that and then get a graph of each of these stocks and their historical dividend yield. And this is helpful as well, just to kind of get an idea. You don't want to see kind of spiking crazy dividend yield. You just want to see something pretty consistent, and you want to see they've got a long history of paying dividends. We look at CVR Energy right here, for example. We can see this chart only goes back to July of 2013. So either there's missing data or they've only been paying dividends for about 2 years. Some of these others that go back 10, 15 years, we've got a nice long history of dividends being paid. And some of these may grow. I don't want to not. I mean, I'm just saying when I see CVI here, I don't see a whole lot of history. If you've done your homework, you think it's a great company, they're going to grow the dividend, absolutely invest it. I'm just talking in generalities based on the Excel spreadsheet we went through. We're going to try to find some stocks that have long histories of dividends. If your goal is safe, conservative dividend growth and letting that double compounding power go to work for you. Now, that's the dividend stock list. The second way, probably the best, is this all-in-one screener. It's a phenomenal screener. If you haven't used it, you could spend days in this thing. It is by and far the most powerful and most capable fundamental data stock screener available anywhere, and all members have access to it. There's several tabs up here at the top, if you can see these. This is the fundamental tab. It's going to search through fundamental data. There's valuation ratios, profitability, growth, depending on kind of how you want to filter your stock down, what type of criteria you want to use. Well, third from the right, you notice that little tab is dividends, and that's going to allow us to search through stocks meeting our specified dividend criteria. So I'm going to go ahead and just select USA for countries to find all the American stocks. For market cap, we're just going to look for at least decent-sized companies to avoid really small penny stocks that may have a less than proven dividend track record. So we're just going to go to mid-cap, $5 billion and above. So you notice here I've already trimmed our list from several thousand down to 780 stocks. So these are the 780 U.S. publicly traded companies with a valuation of $5 billion and higher. You don't have to do that screen. Here you can select whatever country you choose, whatever industries you prefer to invest in. Now we're going to select the dividends tab. Notice there's not a lot of drop downs here because there's not really a lot you have to specify when searching for those yields. So everyone's temptation in my experience, is to go right here to the yield, the first drop down box, and select, I want at least a 10% yield. Now, I'm not telling you that's not going to work out, but I will tell you that over a 20-year period, the guy who just didn't look for the highest yield but look for the proven track record is probably going to do better just because of those amortization tables we looked at in Excel and the compounding effect. So I don't even mess with the yield. It does have a yield on cost search feature. And what the yield on cost is, we saw in that Excel spreadsheet, right? We see how, in this example, as the value of those holdings increase, the dividend increases, your yield on cost increases. So 5 years in with this stock, we'd be yielding almost 6% on our $100,000 investment, right? Because we're getting $59.54 a year. So to the same tune, the yield on cost looks at the previous 5 years of dividend growth. So it gets an average dividend growth rate over the last 5 years and assumes, assuming they will continue to grow dividends at the same rate they have previously, that's what your yield on cost will be going 5 years into the future, okay? Now, my most important thing is two of them really, is the dividend growth rate and the payout ratio. So for growth rate, play around with these numbers, find what trims your list too short and what gives you too many stocks. Like the example we ran on that spreadsheet was looking for at least a 5% dividend growth rate. You see we've still got 247 companies here, so plenty of companies have a history of this. The payout ratio is a big one. The payout ratio, again, is the percentage of the company earnings that are being used to cover the dividend. So obviously, the lower the better, right? If it takes ExxonMobil 80 cents of every dollar in profit to pay that dividend, then if their earnings fall 10 or 20%, all of a sudden they're having a hard time meeting it. Now, if it only takes 10% of their profits to pay the dividend, they could have a terrible year and still have no problem paying the dividend if not growing it. So I like to set this at about 50%, 60%, so 0.5, 0.6, somewhere in there. We'll go to 0.6. You see it trims us down to about 62 stocks. So these are quality, these are large stocks that are using less than 60% of their income to pay the dividend, that are growing their dividend at least 5%, and then becomes the minimum years of dividend increase. That means how many years consecutively have they increased their dividends. So you can go back as far as you want. I mean, you can look for companies that have been paying dividends for 40 years. Not going to be any on this list. Let's try 30. There are actually a couple here. PepsiCo, Kimberly-Clark, Air Products. I think that's excessive. I don't think you need to go back that far. I'll look at, like, say, 5 years. Oh, thank you. I'll look at, say, 5 years here because I just want to see a recent history. A lot of stocks, a lot of companies had to cut their dividend or slash it in 2008, 2009. We know that's sort of a black swan event, so I don't want to penalize them for that. Now, as David and Chris have pointed out, I did do the payout ratio in reverse. I apologize. It's my mistake. The left drop down is the minimum. So I'm going to leave that alone. I'm going to set the payout ratio maximum to 0.6 or 60%. Okay, so thank you for addressing that. We can even probably drop it down to 50%. Yeah, and still have a really nice list. So this is what we've got now with minimum 5 years of increase. You can go to 10. You'll still have a decent list. But again, I just don't want to cut any good companies that missed a payout there in 2009. So now I've got a pretty big list. There's still 132 stocks in this. Some of this you'll cull through and probably decide to cut yourself. You may look at Best Buy and think, I don't know if they're going to be around in 20 years. I don't want to hold. There may be some other ones you want to cut. I suggest going to some fundamental data and trimming it down a little bit that way because we've got all quality dividend payers now. And now we just want to trim the fat and get really quality stocks. So one of the nice things here is let's see, where is it listed? Predictability. Right here in the middle on the fundamental tab is predictability. And you'll see this at the top. Anytime you go to a stock, you'll see it's got the stars on it, anywhere from 1 to 5. So for instance, if we look at Apple, right up here in the top, you see Apple's 4.5 stars. The predictability rank is proprietary to the Guru Focus website, but what it does is analyze the stock's history of revenue growth, net income, EBITDA and looks for those that have the most consistent growth. Okay, so it wants one kind of like a Walgreens that's continually making 7, 8, 10% growth per year, not one that's up 100%, down 20, loses money one year, makes money the next. So higher probability companies tend to be more solid, more dependable, and have cleaner histories. So with predictability here, you can go to set our minimum to say 4 stars, and you see how much that trimmed our list, right? We're down to 48 stocks now. Without that, we were at 132. So it'll cut it down by 60 or 70% here, just taking 4-star stocks. And if you want to go a little bit further, you can. If you want to find some that have, a PE below a certain level, or their financial strength meets certain characteristics. Again, every investor has different criteria for them. But this is going to find you some pretty quality stocks, just with this list we've got here. So we've got 48. If we want to look at one, maybe has a decent return on assets, or return on equity, excuse me. Let's say, 6% or more. Still not trimming it. Let's look for 10%. Still not trimming. I mean, you see, as we put different criterion on here, our number of stocks is remaining at 48. So these are quality stocks that are meeting our tests as we approach this. We like trimming at margins. We can go to the growth tab and let's see some revenue growth the last 5 years. At least, let's say 5% a year. Didn't trim it much. About 10% a year. There we go. Now we're down to 20 stocks. So, and the majority of these names you're going to know, right? There's a reason these are blue chip stocks that you've heard of, and there's a reason so many mutual funds own them. We just went through the reasons why. They pay healthy dividends. They don't use too much of their cash. They've been increasing them every year. They're trading at reasonable valuations. They're predictable companies. And you're getting pretty much a nice little list of blue chips here. Aetna, Ametek, CR, BlackRock, CVS, Grainger, Nordstrom, Nike, Ralph Lauren. You've heard of a lot of these. So it's kind of up to you how much you want to apply here to, how many of these criteria you want to apply to this and what's really important to you. But that's going to trim your list pretty well. And once you've done that, there are a few ways to view this material. Now, we've got it set on active filters, right? So what that means is, and that's this heading right up here at the top, says active filters. The filters we've applied to it are what is being shown here, okay? Now, you can customize this if you would prefer. You can look at these based on dividend criterion, which is already set up for you. So it's going to show you the yield, the 5-year yield on cost, the payout ratio, and the dividend growth rate. And those are really the big things you want to know. If you want to customize it, just click on the Customize tab here, and you can set up your own with whatever criterion you want displayed. But we've got a list of 48 stocks. We can filter this by yield on cost. And again, this is going to assume 5-year projection that they grow dividends at the same rate they've been growing them. So we can get kind of a pretty rough estimate of what our yield on cost will be several years out of the future. Another thing you can do is add these to a portfolio. So right down here at the bottom, we've got a total of 48 stocks. There are some options, if you've never used it, these virtual portfolios you can hold, and even free members can do this on the Guru Focus website. So you can do the stocks on this page or for all stocks. So notice there's 2 options. Now we've got 3 pages of stocks here. This button, I believe, is just going to add to the stocks on this one page here. The button to the right is going to add all to your portfolio. Okay, so let's go ahead and do that. I'll show you how easy this is. Add to my portfolio. This little box comes up. You can select a portfolio you already maintain, or you can just add these into a new portfolio. This little window pops up. You can name it. Let's say you want to name it high yield. It's got all the tickers listed there. And then you just hit create portfolio. And now what you've got is a virtual portfolio that will be maintained, comprised of all these stocks as of today. Now, if you want to go back and see, what if I bought them a year ago, maybe I own some of these, you can adjust any of this data you want to. So I know it's small on your screen right now, I apologize, but the columns, obviously you can see the symbol, the current price, and the day's change. This is date added. So in other words, the day you purchased the stock, your cost per share, how many shares you have, its value, and several other things. So what we can do is I'm going to click on this little date added, one of the dates beside one of these stocks, and show you the options you have. We click on that date. And then let's say we bought this maybe 2011. Okay, we'll just say 4 years ago, May 19th, 2011. It automatically gives me this pop-up that shows me the closing price on that date. So you can either use that price, or you come in here and say, I actually got it at 82.05. I had a good buy that day, whatever that may be. You put in the number of shares, say you bought 100 shares. And if you really want to get specific, you can put your $7.95 commission in there and hit save. And now it's tracking the stock, right? What we see across the top is it's got its current price, your cost basis on it, the value of the holding, the percentage gain, the dollar gain, and what you're yielding today. Now, the only thing this doesn't do is accumulate the dividends. So 99% of portfolios is great for if you're looking to back test and see what if I had all these stocks, what my value be. It does not include the dividend payouts in the total value, but it will allow you to track your stocks and kind of maintain them. Now, someone asked if they can see X dividend dates in a column. I don't know if the X dividend date is going to be available in here. I'll have to check. But if you want to email Craig, if you want to email support@gurufocus.com, they can definitely let you know and tell you if they don't have it, tell you if it's possible to add it to you. But that's kind of the screener and how that works. Again, I think it's really powerful. We just kind of touched on it here. There's lots and lots of criterion you can add to this. If you want to find stocks that there have been, recent buys by a number of gurus, or you want maybe at least, 10 fund managers to own the stock. Again, this is based off my gurus. You can see here. You can select all the hedge fund gurus, for example. You can do any number of things. But this gives us a nice short list, ones that a lot of people hold. You can select the weighting in their portfolio to find those that are substantial chunks of the money they manage. Any number of things you can search through here. But that's how to use the screener to find some quality dividend stocks. But again, I can't tell you strongly enough how important these three things are over here: the growth rate, the payout ratio, and the minimum years of dividend increase. It's up to you to decide how many years of increase you want to put, but definitely find one that has a long history of growing that dividend and is not using 100% of profits to do it, because we don't want that dividend to be in jeopardy in the event of bad economic times, right? If you look at the history, if you go back and say, what is the S&P return over the last 20 years, they'll give you, let's say it's 180%, 200%, whatever that number is. Generally, about half of that gain is from dividends. Half that gain is from dividends. So if you're getting quality dividend-paying stocks, and again, if you look at our list, if we're looking at Chevron, Equifax, ExxonMobil, CVS, CSX, Ralph Lauren, I think you would agree that over a decade or longer, these stocks should grow about at pace with the market just in their share price. Add into that top-tier dividends that are growing and compounding and reinvesting, and it's very easy to see how you can outperform the market. How many people in here watch the show Shark Tank? Anybody ever seen that? It's a great show if you haven't seen it. It's on, comes on CNBC. Mark Cuban's on there, a handful of others. One of the guys they call Mr. Wonderful is Dennis O'Leary, or David O'Leary, excuse me. And he actually runs a fund called O'Leary Funds. And the primary focus of his investing is dividend stocks. And his actual motto for O'Leary Funds is, get paid as you wait, because he knows he wants constant cash flow. When you notice him doing deals in that show, he's always looking for some kind of perpetuity. He's always looking for some constant payout. He wants a residual. He wants, 30 cents on every unit sold, because he thinks like a dividend investor, and that's how he's become so wealthy. Now, the other way to find dividend stocks, especially if you're one that follows other gurus, is to look at their current portfolio. So let's just search Warren Buffett, and we're going to go to his current portfolio. Okay, now Buffett, we all know, no introduction needed here. And of course, the tabs at the top, one of his current portfolios. So it's going to let you know as of his most recent filing date. These were released, I believe, on Friday, the 15th, as of the end of the first quarter. This is his holdings. And one of the tabs up here, notice you can filter these: valuations, undervalued, low PE. The fifth one over is top yield. And what that's going to do is show you the holdings in his portfolio with the highest dividend yields. So we click on that, and here they are. Once again, like anything else, you can filter this by yield. So double clicking that gives us the highest yields on top, going in descending order. And you see he's holding Verizon at 4.4, National Oil Well Fargo at 3.7, GM at a little under 3.5, and a handful of others. And you can do this for any guru, right? We can look at Tepper. If you want to look at David Tepper's portfolio, find the dividend stocks he's holding. But it's a quick way if you're looking at someone. Notice Tepper's a big growth guy. He doesn't have a lot of dividend stocks. These are the three he's holding: Lorillard, GM, and Huntsman. Out of his 38 stocks, only 3 pay dividends. Now, his top growth stocks obviously has larger holdings, but it's a really nice way. You're in there, you're looking at someone's portfolio, you're trying to see, what's Buffett buying, what are his holdings, what are his sector weightings, and you can just quickly take a look at, let me see what dividend holders he's got. Where's he putting the money? You notice he's David Tepper's holding General Motors, 10% of his portfolio. Anyone who has not researched General Motors and their forward earnings rate and what that stock might do in the next couple of years, I would encourage you to put that on your research list. So those are the main tools to identify high quality dividend stocks, and how you do it from there. Again, I think a nice way is with those virtual portfolios. I don't know where mine went, so I lose track. Oh, up here at the top, my portfolios, we put the one high yield together, and you can monitor this portfolio. You can make additions to it. You can make subtractions. But it's a nice way to kind of track it. Even if you just want to track it in your mind, say, well, these are the ones I'm thinking about buying today. Come back in a year, see how they performed, and sometimes you end up kicking yourself for the fact that you didn't buy them. But it's a really nice way to kind of keep track of everything. And if you are a serious investor, which I assume the majority of you are, and you want to have several portfolios, you want one on dividend stocks. I've got one here for book value growers, overvalued stocks, the index, a handful of others. You can maintain as many virtual portfolios as you choose. Now, Pog's asking about yield on cost. Pog, again, the yield on cost, what that is it shows you, it's a hypothetical figure of what your yield, the dividend yield will be 5 years from now based on what you pay today. So it essentially takes a stock like, let's say, Exxon, and it goes back and says, well, the last 5 years, it has grown its dividend, say, 6% a year, whatever that is. It's okay, if that's the average of the last 5 years, we'll assume that's going to be the average of the forward 5 years. And if that maintains, then buying at, say, 86 will produce a dividend 5 years from now that will be roughly a blank yield on cost, your cost being today's share price. Now, finally, the articles tab. I'm sure a lot of you see the articles. You get emails with hot articles in it. It's not the end all be all for stock research, although there are a lot of really qualified, really smart people. Some very large portfolio managers occasionally submit articles in here. But you can do a search in the top right under keywords, whatever that may be. If you're looking for tech stocks or semiconductors or REITs, whatever. I'll just search dividend. And we get some articles that come up. So some of them may just mention the word dividend in it. Some of them are going to be ones that may spark your interest. Warren Buffett bought these 8 dividend stocks. This one by the Dividend Guy blog, What I Hope My Kids Will Learn From Me About Money. There's another writer, Dividend Mantra, who's a big dividend investor. He's looking at sector allocation as it pertains to dividend growth investing. So even if this just kind of becomes sort of a chasing the rabbit kind of a thing, oh, see this article, let's take a look at it. Kind of like what this guy says. Let me take a look at his other articles. He's obviously a dividend guy, and you may get a few ideas from it, right? So again, it's just you got some time, you burn some time, you're doing some research. I think Guru Focus has got a lot of great content, a lot of great contributors, and it's a nice place to find some ideas that maybe slip through one of your filters. So that is the gist of the dividend side of this website. I'd like to go ahead and take questions from you guys now. And if there's anything I covered that makes sense or anything you want to take a look at, let's go ahead and address that now. So Raphael asks, is a private investor from Chile. I mentioned the top dividend yields go around 3.5. In my country, I found a few stocks that have a high dividend yield of average of 9 or 10% over the last 10 years. Since Chile is a fairly new market, should we assume that yields will not be that high in the long term as the market develops? Raphael, really good question. I can't speak too intelligently on the Chilean market. Although, look, if you're getting 9% yields now, I mean, from quality stocks, as long as it's not taking, as long as their payout ratio is decent, they've got a decent history of doing that, I see nothing wrong with it. Generally, financial markets that are paying those higher dividends are probably in a higher interest rate environment right now or a higher inflation market, right? If you want to see the history of dividends, use this site, multpl.com. I have no idea what it stands for, but it's got a lot of economic data, and it goes all the way back to 1880. Notice across the top here, one of the options is the S&P 500 dividend yield. So it's going to give us the average yield of all the U.S. stocks in the S&P 500. And this is a chart going back to about 1875. So as you can see, today's dividends are about, the last decade or so is about as low as it's been in all of time since we've been trading stocks, right? So it's extremely low because what you'd see if you overlaid a chart of, well, let's look at this real quick. If you overlay a chart of maybe the 10-year Treasury rate, you're seeing something very similar, right? Since about 1980, the 10-year bond rate has gone from 15.5% down to, around 2. And the dividend yield since 1980 is doing the same thing, going from about 6.5%, 7% down as low as 1. So it's all about the capital market yield, right? I mean, when you've got 10-year bonds yielding 5-6%, no one cares about a stock yielding 3%, so the stock price will come down to produce a higher yield. When treasuries are only yielding 1.5%, 2%, then a 3%, 3.5% dividend yield is that much more attractive. Now you can look for, you can find plenty of U.S. stocks paying 19, 20, 25% dividends. Generally, they're in some kind of a trouble, or they've had a huge whack in the stock price that's pushed that dividend yield much higher, and you'll come across some of those. That's why I like to search for the payout ratio. Beiji asked, do we have to find the intrinsic value before investing in these dividend companies? Otherwise, we overpay for stocks. So, Beiji, good question. As far as intrinsic value, look, there's several ways to look at it, and every investor out there is going to value a stock a little bit differently. I'm going to assume you're looking at something like discount cash flow or something to that regard. It's up to you how you value them. I mean, as Warren Buffett once said, it's better to buy a great company at a fair price than a fair company at a great price. And that's incredibly, incredibly true, as I've learned the hard way. Sometimes you're going to overpay for some stocks. Sometimes you look out there, if you only want to invest in top quality blue chip companies, you may not find one in today's market trading at 10 or 12 times earnings, or trading at book, or trading at a substantial discount. So, if you pay maybe on the rich end of its history, that's generally okay if you have a long time horizon, they've got a history of growing dividends, and you've got cash flow coming in. If that stock goes from 80 down to 60 next year, you're not overly concerned because the dividends are what you're after. They're continuing to pay, and you actually hope it pulls back, to be honest with you, because as you're reinvesting those dividends in new shares, you want the price lower to accumulate more and more shares, as long as you're comfortable that over the next 5, 10, 20 years, that stock will appreciate and grow with its economic growth. Alvaro asks, can Guru Focus in the future add the cash flow of dividends in the portfolio? Yeah, Alvaro, ask Charlie. He's the owner of Guru Focus, one of the smartest guys you'll ever meet. He does the majority of the programming. Send an email to support at Guru Focus and ask him about that. I'm not technically as knowledgeable as he is, so I don't know how difficult that is to add, but we can definitely take a look at it. Bill, can you speak on the possibility of a currency crisis in the U.S.? It's been reported some countries have been getting out of U.S. Treasuries since this noise. Bill, I honestly don't know. I mean, obviously there are countries that are not crazy about the U.S. dollar being the world reserve currency. There's some getting out of it. The best way to look at U.S. Treasuries today, they're kind of the best house on a crappy street, right? I mean, we've got $17 trillion in debt. You know, we're not, our solvency is not fantastic, but if you go look at Greece and you go look at Europe and you look at some of South America, we look better in comparison, which is why there's still a market for, federal treasuries. Noel, can one screen on credit ratings of companies such as S&P, Value Line, Moody's, etc., and all in one? Credit, that's a good question. I don't know if credit ratings are provided in here. The reason being, all of this data comes directly from the Bloomberg data feed, and it's going to be an issue of whether or not that data is included. It's not part of any federal filing. It's only held by those individual credit agencies. I don't believe it's in here, but it's possible. No, worst case, you put together your list, you may just run a quick scan of each of those to see where they lie. But good question. Jim asks, if you're investing for the long haul, is it better to buy any dividend-paying stock today with market yields below 2% or wait for future pain in the market? Jim, I mean, that's the age-old question, right? I mean, what's the stock market going to do tomorrow? I know you're paying the worst. What you don't want to feel is you don't want to be the sucker who bought in 1999 or 2007, right? I don't think we're in for any kind of a huge market correction in the next several years. Okay, everyone's worried about rising interest rates. If the Fed does in fact raise rates their next meeting, it's going to be 0.25%. Okay, it's going to take several years before we see 2, 3, 4% interest rates that will actually adjust the market. And by then, these companies will continue to grow and continue to increase their revenue and their earnings and be in a different market. So if you're looking for the long haul, no, I'm buying today. I don't want to pay ridiculous prices, right? I mean, I don't necessarily want to buy. Netflix is not a dividend paying stock, but if it were, I don't really want to pay $600 for Netflix when I could have got it 63 years ago. But for the most part, as long as valuations are in range, as long as the forward earnings is at a decent multiple in line with the market, I think it's much better to buy today. Russell, if the stock market crashes, will blue chips still maintain their dividends? Yeah, Russell, I mean, the good ones do, right? And that's one of the reasons we look at the dividend history. I mean, if you go back, you can see the dividend history of these stocks. And let's take ConocoPhillips for example. We'll go to the stock page, right? And if you go to the 10-year financials, one of the ones in the top is the per share data, and it is the 1, 2, 3, fourth from the bottom. Right here says dividends per share. Okay, and like anything, you can click on this in the middle, and it will graph it for you, which is a great feature. So if we click on dividends per share, I mean, I think 2008, 2009 is about as good a stress test as you can give a company. And here it is on quarterly and annual data going all the way back to 1996. They've got 20 years of always paying a dividend. If we look here at the 08-09 crisis, they didn't miss. They continue to pay it. It's nice little step ups. This is what you're after. Okay, over the last 5 years, they've averaged about 5.96% annual dividend growth. It's a nice, smooth, growing dividend graph. That's what you're after. This silly looking graphic right here will build immense wealth over a long period of time. But really good question, and that's Russell. That's the way I look at it. I mean, if you look at kind of a junkier company, you'll see one that kind of does this, and then it went to zero, and they didn't pay, and they paid a little, and it's kind of all crazy. If you find a nice smooth one like this, though, that's a real quality dividend payer, and that's really what I'm looking for long-term holds. Bruce, is everything I've shown you today available to free subscription? Bruce, some of it is. A lot of this data is available to free subscription. The all-in-one screener, however, I believe is a premium feature. So you'll need to be a member for that. But I assure you, you'll get your money's worth out of it if you decide to be a member. You can always give it a try. I think you can get like a free 30-day trial or something. So if you try it out, see if you like it. If you don't, you can always cancel. I mean, it's no hassle. I promise you. Yeah, Jim says when your alternative is zero, anything with a pulse seems to be attractive. Exactly. Beiji, silly question, but if you look at history, every 7 years there's a market correction. Do we expect one this year? I mean, I don't expect one this year. Again, it's really personal belief. I don't think it happens every 7 years on the dot. I think we've got several more years of bull market left, but that's just my opinion. That's really up to you. To give you an example, David Tepper, who's the king of Wall Street, go look at his portfolio. Last quarter, he just bought his largest position is call options on the SPY, and his third largest position is call options on the Q. So he's betting heavy on continued bull market, and if there's someone I'm going to listen to, he's got a 30-year track record of nailing it on the head. Rajat asked, are there particular industry segments that maintain reliable dividends compared to others? Good question. I haven't seen really industries that are more reliable than others. There are industries that are less prone to pay dividends. Like if you look at the tech sector, they're less prone to pay a dividend because they're still growing and they can allocate that capital to ways that they feel will benefit the stock price better than a dividend. But I don't think it's really industry specific. It's more just the caliber of the company. Look, Walgreens has got a fantastic track record. ConocoPhillips, ExxonMobil. John Deere. These are companies that are the leaders of their industry and have great track records of dividend pays and increases. Yeah, sure thing, Jim. That MULTPL site, multiple.com, it's just got, if you click on more, it's got a bunch of stuff. I mean, sometimes you're just curious and want to do some research. It's got all kinds of economic stats on it. The Shiller PE ratio. You can look at treasury rates for the last 30 years. You can look at pretty much anything to give you a big picture macro view. Miles asks, how important is it to diversify in dividend companies in our portfolio versus holding only a small few? Miles, I mean, it's like anything else, right? Warren Buffett's been quoted as saying, diversification is for people who don't know what they're doing. So but I mean, he deserves to say that, right? He's got the power to say that. I don't believe you need to over-diversify. I don't think you need 50 different stocks, 100 different stocks. If you're picking kind of smaller cap, more risky companies, yeah, you want to diversify a little bit more. You don't want some penny stock taking 20% of your portfolio. But look, when you're looking at ConocoPhillips, you're looking at Deere, you're looking at Ralph Lauren, these caliber companies. I think it's, in my opinion, fairly safe to put up to 10% of your assets into any one, your liquid assets. Richard, as far as accessing this is being recorded. You'll get a link to this tomorrow. It'll be on YouTube as well, and you can rewatch the session if you wish. Bill, that was he asked who the investor was with the 30-year with the large position in calls. That was David Tepper. If you guys are looking for a guru to get ideas from, this is your man. David Tepper managed a little over five. Well, he actually manages more like 20 billion, but this fund has 5.7 billion in it. When you look at his performance, for some reason there's not data past 2010, although I know he made like 40-something% in 13. His returns are astronomical. Astronomical. The 15-year cumulative number, 3,680% versus 166% for the S&P. Guy's an actual rock, just an absolute monster when it comes to the market. Anyway, here's his current portfolio, and when you do it by weighting, these are two positions he just picked up in the most recent quarter in yellow, and those are call options. One is on the SPY and one is on the Qs. Now, we don't know what strike or expiration, but if you go out and look at an option chain and see what the open interest is, you can get a pretty good idea probably of what he's holding. But, I mean, those are pretty heavy bets, right? Of $5 billion, he's got basically, what, $1.5 billion, $1.25 billion of it in SPY and QQQ calls. So, really, really bullish from this guy here. Last question: is there a way to screen for stocks near their historical high yield? Good question. Let's take a look. If we look at, I don't believe you can scan by historic high yield. I could be wrong. I know you can display it. So if you're looking at a list of stocks, let's take a look at some here. So one of the things you can display here, if we go to customized view, one is the 10-year dividend payout. I'm looking for the 10-year dividend yield. And forgive me, I wasn't prepared for this question. I'm sure it's in here somewhere. You can find the dividend growth rate. But anyway, when you use these, we'll just save this view. Take it a second to come up because I'm broadcasting. But you get an idea of the 10-year payout range. And you can pretty quickly see where it lies within that, right? So under financial duress is the highest their payout range has been. In fantastic times is the lowest rate and the lowest it's been. So the further to the left they are is mean they're using a smaller percentage of their profits to pay dividends today than they have in the last 10 years, which is a good sign. It's extremely healthy dividend, and it's at no immediate risk of not being able to be met. All right, well, everyone, it's about an hour. I want to go ahead and close it up and thank you guys for joining. If you have any questions, feel free to email us, support@gurufocus.com. As I mentioned, this webinar has been recorded, and it will be in a link in an email you receive tomorrow at the conclusion of this webinar, and archived on the Guru Focus YouTube channel as well if you want to see any past presentations we've done there. We thank you all for coming. We hope you learned something from it. If we can do anything for you here at Guru Focus, please feel free to reach out to us either by phone or email, and we are happy to have all of you as members. Thank you for your continued support, and everyone have a great Tuesday evening.